Investors say goodbye to October after a huge week of earnings reports and the rate cut by the Fed. Now the focus turns to the jobs report, which is due out less than 2 hours from now. Joining us right now for a look at the broader markets is Scott Nations of NationsShares. Of course, our guest host this morning is Joe Terranova of Virtus Investment Partners. Both of them are CNBC contributors. And Scott, since you're new to the table, we'll start with you on this. What do you expect for the jobs number? What's the market expecting? ISM, do we really get concerned if these numbers are weaker than anticipated, or does it get written off because of the GM strike?
Becky, I think you've lined it up perfectly. We're going to expect 90,000 new jobs for the headline number, but we're going to look through that data. We're going to look at manufacturing. We expect to lose 50,000 jobs in manufacturing, and that's where people will really pay attention. Because if that's better than expected, that is, if we lose fewer manufacturing jobs, then that means that the GM strike is going to have less impact. If we gain 90 headline and we lose 50, then that's going to be as expected. I think people are going to discount it because of the strike. And as you pointed out, we're going to start looking at ISM data. We're going to take a look back at the Chinese PMI data, which was better than expected, even though that data is a little wonky. We're going to look at the China data, and we're going to say, you know what, maybe things internationally are not as bad as we feared.
Joe, what do you think?
So I think back in April when I visited with you, we talked about the third year of the presidential cycle. First year of President Trump's presidency, he enjoyed 19% higher. Last year, he had 6% down. I don't think there was much credence given to the fact that the third year of the presidential cycle is a very strong one. You go back over the last 70 years, the average annual return is up 16%. So
you think we're going to get big gains from
here? Well, I think the question becomes, do we have a chase for performance? Because I think sentiment has been depressed and defensive in broad asset classes. You look at all the asset classes, total return S&P is up 23% for the year. Investment grade is up 12%. High yields up 14%. REITs, municipal bonds. I could go through the litany of assets. Everything is higher. And that comes in an environment, Andrew, where EPS is flat for the year. EPS is flat. So we've had multiple expansion.
But you think the chase to go higher continues?
It has to.
It has to. It has to, because there's other people who think that the emperor's wearing no clothes.
Well, who's the emperor?
Well, I mean, the argument being that that if you have no EPS growth, that this whole multiple expansion story is crazy.
We've had that for the entire year, but what's the difference in 2019 versus 2018? The difference is you have a friendly Fed versus a hostile Fed, rather.
Well, we've been treading water, basically. If you go back a year, we saw the huge dip for Christmas Eve.
You're year on year, you're still relatively
flat. For the
flat.
year to date, we're up, but for year over year, you're basically treading water. But you think from here, it's like time to chase because we're treading water.
And the important level is interest rates. Joe, you may be right about the president being in his third year, but he's had very little to do with the fact that the 10-year has dropped from essentially 3.2% to 1.7%. And that, but that's the reason the stock market is higher. I mean, in a situation like that, with the 10-year yield dropping by 40%, about 150 basis points, and earnings being pretty good, not great, but pretty good, of course the stock market's going to do better. I don't think that the stock market has to do great with 10-year yield at 1.7% for us to do well. I mean, the fact is likely that the president has caused more problems for this market.
But the conversation, Scott, the conversation is not
else.
This conversation is not about the president.
No,
the conversation is about the market. It's about the liquidity that I think we're saying the same thing. It's about the liquidity that the Federal Reserve has injected. So Scott brings up interest rates. Yeah. In 2018, the average 10-year yield was 2.91. The average 10-year yield for 2019 is 2.19. Profit margins in 2019, for the first time in 4 years, profit margins are actually going to be lower for S&P 500 companies.
And Joe, I would add to that, if you're looking at next year, then you're in the fourth year of a presidential cycle, a president who wants to get reelected and is probably going to make sure that he's a little more cautious about doing things to put a stopping effect on the economy, like trade wars or things.
Going back historically, when you're in an election year, the first 3 to 6 months are challenging. And I would expect that for assets. I would expect assets to run into the natural headwinds of the uncertainty surrounding an election. But where we're positioned right now, sentiment continues to be incredibly defensive and
so you think it's catch up?
Just focusing on non-belief. I think it's one of the reasons why Apple is rising so dramatically.
Yeah, I'd buy into that.
It's been a good year, and I think I can't see much disrupting it.
Hey, Scott.
Becky, to your thesis.
Go ahead.
Well, to your thesis, he got elected by speaking to people who generally seem disaffected. And by being brash and outrageous. Doesn't he have to cement that base by continuing to be brash and outrageous rather than throttling it back and being to use a word that we don't use very much, presidential? I mean, isn't he going to go out there and, if nothing else, ramp it up?
I don't know. I don't know. My biggest take is I would assume that he wouldn't want to be too brash with the Chinese, I'm guessing, just because that's the type of thing that could hurt the economy, and that's something I would imagine he doesn't want to do heading into election year. Anyway, Scott, it's good to see you. Thank you for joining us today.